Hey, good morning, traders. Today is Friday, September 16th, and this week's weekly update, we're going to talk about how some major levels have broken and what that might mean for future market conditions. We're going to talk a little bit about this missed CPI estimate. We're going to talk about new inflationary data that I am seeing on the horizon and what it might mean potentially for the Fed's future upcoming rate hike. Is the market possibly overreacting, or is the market's reaction justified? So let's get into it. We have 20 minutes for the TradingView people, and I might go a little bit longer for everybody else. So if you're seeing this on TradingView and the video quits at 20 minutes, you want to see the rest of the content, then unfortunately you're just going to have to jump on over to my website or YouTube where you can find the rest of this video. Let's get started here, guys, today. And the chart we're looking at right now is Ethereum. We'll get to that in just a second. First, what I wanted to talk about is new inflationary data that I am seeing. Now, why do I keep talking deflationary data? Sorry. Why do I keep talking and bringing up, pointing out examples of deflationary data? So here we have new one-family houses sold. And it is significant that since this cyclical bull market, secular bull market, whatever you want to call it, started in 2009-ish, we have remained above this. The big one here is this this red level. All right, let me get out my pen and just point to it. And you can see it right here, this red level we have remained above. But just recently, in fact, that was in May, we broke below that and the 100-day moving average, and just more recently, in June, broke below the 200-day moving average. That is very significant, along with this level that I have, this trend line, this ascending trend line, broke below that. All right, so one family houses sold is pointing again to major real estate deflation. I want to bring up something else here very quick, and then I'll get into why I keep bringing up this deflationary data. Actually, might as well do that right now. Why do I keep bringing this up, guys? Because I think maybe I hope, maybe that's a better word. I would assume that the Fed is got to take this into consideration in their next rate hike. I mean, more than CPI data, I said CPI, because a lot of the data there is lagging, it is skewed, and doesn't really indicate to the full extent, in my opinion, what is going on in the economy. And we're seeing major signs of deflation data coming in. All right, so I just posted this on my Twitter account. The U.S. housing market just saw the largest single month deceleration in the past 40 years. So for the first time since the pandemic, homes are now selling below asking price. And there is a chart here with some data indicating the cities that have really experienced deflationary pressures in the housing market the most. I just want to quickly reference that as well. All right, so deflationary data or disinflation data is coming in fast and furious. It's coming in hot, a lot faster than what we're seeing reflected on the CPI numbers. All right, though month after month, inflation has come down. We have to remember that. All right, so I guess the purpose of me going chart after chart oil, gasoline. Let's just jump there as I'm saying these things, and just showing you, the prices coming down. Chart after chart, we've fallen from this channel here in oil. All right. Gasoline come under a major trend line here. All right. And then U.S. housing starts is deflating as well. And I mean, I could, go into all of these charts that I've gone into in the past videos, but I won't do that. It's just freight. Everything is showing us that disinflation is here already. So the big question becomes, is the Fed going too fast? Now, I know there's a lot of critics of the Fed that are upset that they didn't go fast enough and aren't going fast enough. But what I'm seeing from the disinflation data is that they are going at a rate correspondent to that which they should. Possibly, they should consider at least staying consistent with what they've stated. That would be 75 basis points, but not increasing to 100 basis points. A lot of people think, and the market now, I forgot what it was, they baked in a 35% chance, I think it was the last time I looked, that the market will go 100 basis points. Some people think that Jay Powell and company will go Volcker style and raise the interest rates all the way up to the rate of inflation. I very much disagree with that. And if that happened, we would most assuredly go into a Great Depression. I mean, there's no question in my mind at that point. Now, a lot of you conspiracy theorists are saying, well, that's exactly what the Fed wants. I don't know. I can't base my trades off of conspiracies, guys. I mean, I know you have to have a little bit of that conspiracy style mentality in you to make future trades, because that's essentially what you're doing a lot of times with investments, is you're predicting based upon fundamental analysis, based upon technical analysis, based upon macroeconomic conditions and price valuations, PE ratios, etc., what that price will, you're projecting what that price will be. So that is all future thinking, all right? You're projecting a price without knowing it, and therefore that, in essence, is the definition of conspiracy. Just saw something here. I'm going to draw it out while I'm seeing it, and that is a trend line right here. All right, so we do have some support on the RSI. This is the daily RSI for U.S. housing starts. All right, now let's get into if the Fed considers this data that I have been pointing out for the last couple of months, this disinflationary data that is coming in fast and hot, and if they prioritize that over the CPI data, I think, considering or assuming the Fed has the U.S. economy and the general public's best interest at heart, they just stay the 75 basis points, and possibly the next rate hike after, of course, again, CPI data comes in. The big thing is month over month, inflation has come down. All right. It started with 9.1%, 8.6%, and this last one was 8.3%. All right, so inflation is coming down. The argument is that it's not coming down as fast as it should. It's understandable, but it will. Remember what happened in 2020. I mean, we had something that never happened before. So I think the market here is overreacting, freaking out, and thinking that, Jay Powell and company are going to get even more aggressive. I don't know that that's the case. I would argue that it's not the case. It's not going to happen. I think Jay Powell and company will just stay steady at 75 basis points, which has already been baked in. And what has happened here with the, in my opinion, oversold conditions on this latest CPI estimate is that the market is now, they took 50 basis points off the table and they're now baking in 100 basis points. And the argument that I'm making is that they shouldn't be doing that. However, let's look at these charts from a technical basis point now and talk the rest of the video about our technical, what the technical indicators are pointing to. So you can already see right here, we broke below a major level of support on the US 500. That's significant, guys. We have to watch that. That's telling us we are going to probably come down to the next level right here. And that is currently at 3,800-ish. All right. And if we break that, then all hell breaks loose, quite honestly. Look out below. All right. But we were not able to conquer our resistance on the RSI. And that was the big one. That coincided with this previous neckline here on the head and shoulders pattern. Again, target down was reached exactly. Now, previously I had estimated we'd come down to the 100-day moving average based upon what I projected the CPI data to be. That estimate was missed, and that is why we broke below that and actually broke below this level of resistance here. All right, so we're getting in dangerous territory, if I'm being quite honest with you. And today is quad witching on the markets. So expect a lot of volume to come in and a lot of volatility. And I think that could take our SP 500 all the way down here. At which point, do I know what's going to happen? Absolutely not. I mean, honestly, at this point, with everything that's going on, it's just a guessing game. And that's what makes trading in this market dangerous. All right, let's get on to the next chart here I have drawn up, and that is Ethereum. Of course, the big merge has happened, and then what happened? The bears kicked in. I mean, I don't know. Some people say this is all manipulation. Could be. I don't know. I'm going off of technicals right now. Those of you who have been watching my videos know I put in a short and I took some longs off the table for a loss. This is hard to trade, guys. I mean, the best traders down here do not do well. And I'm not including myself into the best traders. You guys have heard me say it time after time. Yeah, I can trade a bull market. A bear market, I can trade, but barely. And so far, I have not been doing well at all. If you look at my trade portfolio, I'm down just a bit on the $10,000 challenge. And I kind of expected that. But it's, losses aren't as bad as what they could be. And so I say all that to say, at some point here, when we know, so I've been expecting the trend to go up for one big last blow off top, and that's why I've been putting in these longs in expectation of that blow off top. I still think that it is or could be coming, though the probability lessens every month we get CPI data, and pending what the Fed does. It's really all about the Fed. So the ball is not in our court. The Fed holds the levers at this point. Nevertheless, Ethereum broke below a major level here. This is an inverse cup and handle. I posted this, and we broke that critical support along with the 100-day moving average. We can zoom into the 4-hour chart here, and I've got the 100-day moving average here printed on the 4-hour chart. We're well below that. So I put in a trade, and my target down is actually 1037, believe it or not, on Ethereum. I do believe that unless we reverse here, and then that is indication of manipulation, and go back above that neckline, that's where we're headed, 1037. So what will Bitcoin do? Well, I've said before, we've got 3 touches on the top of this long-term wedge that we formed since November of last year, okay? Almost a year-long wedge. And we've only got 1 and 2 touches on the bottom. A lot of times in these descending wedges, we like 3 touches on the top and 3 touches on the bottom. All right, so we've got a touch here, and touch here on the top. But we've only got a touch here and back here, a touch here. All right, well, you could count this as all of the same time frame. All right, so it is definitely possible, if not probable, that we come down one more time to touch the bottom of our descending wedge. Price on that is about 16,000. I've heard many technical analysis say we're coming down to 16,000 again before we break this wedge. All right, the rest of the data, I posted this chart earlier, and let me zoom out so we can get this text in the boxes. All right, so euro dollars is a prediction of Fed hikes in the future, and euro dollars failed to break above and confirm. It breached the neckline. I posted that, but the 50-day held us down. We didn't confirm with another candle, and as a result, just collapsed. Absolutely collapsed. Is this indicating, is the euro dollar futures indicating 100 basis points rate hike? It could be, guys. I mean, if this is right, we're going to get 100 basis point rate hike. And that's pretty scary because that is going to thrust us. That is, in my opinion, too aggressive. We have to be patient with this disinflationary data that's coming in. It doesn't seem like the Fed is very patient. It almost seems then, if the basis points were hiked 100 basis points, I have to believe the Fed knows what they're doing. And then at that point, it would be intentionally taking us into a recession, which could propel us into the big D word a couple years down the road. And I don't like the thoughts of that, guys, so I'm not even going to say it. That's about all I wanted to get into today, guys. We'll cover the dollar real quick since we have a couple minutes. Still, you could still say this M pattern is legit, but if we break this previous high, watch out, we're going up even further on the dollar. And if the dollar strengthens and the VIX continues its thrust upward in this what I call megaphone pattern, which is what it's looking like it's going to do, everything else will continue to come down. All right, let's take a look at our other indexes here. I've been charting the SPY below that level. NASDAQ, do I have anything on here? I have a trend line I drew from April 2020. All right, we come down and break that, it's trouble. All right, it's trouble for all the markets when we see these major levels being broken. I don't know if I did anything new on the Dow. Okay, yep, broke below this major level. Okay, again, 3 touches. Now, I was hoping, I guess this is a hopium chart. I was hoping this level would hold based upon CPI data and we'd continue our way up and then break out for that blow off top that I've been talking about. Not happening so far. Not happening so far. Though on a weekly basis, we still have that opportunity, right? On a weekly basis, we could pop back up the rest of today into that triangle and then break out. But the data is not looking very positive thus far, guys. So we have to just continue to watch and hold fast to our convictions, play these charts. I have to play what I'm seeing on Ethereum and not go by what I'm hearing in the news and so forth. I have to follow the patterns because the patterns tell me what the charts are going to do. And I'm just going to keep playing the patterns and the technicals as I see them, guys. All right. That's all I have for you today. Hope you found it helpful. And if you did, please like, subscribe, and comment. It only helps to further propagation of these videos. Peace, y'all.